All right. So welcome back, everyone. We have another great retirement planner chat today with my buddy Mike Powers from Manuka Financial. Hey, Mike.
Andy, excited to be here. Thank you for having me.
Yeah, I've been looking forward to this. Thank you for coming on. Before we get into it, I just want to let you know that my grandfather always said, fight fire with fire. He was a great man, but a terrible fireman. You know? No.
Yep.
And I got a couple sock puppets for sale if you're interested in taking them off my hands. Yeah? No.
I love it. I got one. And this is more like retirement related.
Okay.
My manager told me to have a good day, so I didn't go into work.
Wow. That's okay. I bet he didn't think it was so good then.
No, I guess not. And unfortunately, I'm my manager now, so that works out pretty well. But
your manager's a real jerk. Yeah.
That's right.
So anyway, no, seriously, Mike, thank you for being here. Can you give a quick background about yourself, your firm, how you got to where you are?
Yeah, sure. So my name is Mike Powers. I grew up in Richmond, Virginia, which is more central Virginia, about 90 miles south of Washington, D.C. Spent some time working for a large public accounting firm in Chicago after college. Then my wife and I actually moved back here to Richmond about 10 years ago. I'm a CPA, so a certified public accountant, as well as a CFP or a certified financial planner. I have about 14 years of experience as a financial planner / advisor. And before that, about 5 years in public accounting, with part of that during college to help pay for school. Most recently, I left a role as vice president of a large RIA firm here in Richmond to start my own practice about 3 years ago. And that was a lot of it predicated on COVID. Had 2 young kids and really wanted to have a better balance to spend time with my 2 young children who are now aged 6 and 4, while they actually want to spend time with me, as well as still have a really good practice and something that I'm proud of and something that I can get excited to go to work every day. On the personal side, I love staying active, spending time outdoors, exercising outdoors, and traveling with some big trips this year and next year are already planned. So
awesome. Now, I think this ties into travel, but your firm name is Manuka Financial. All I know about Manuka is that really expensive honey that you get when you have like weird ailments that medicine doesn't seem to cure. So what's the story with that?
Which I actually have a jar. My mom actually just got me one for my birthday present this year. It is a higher end honey. But the backstory of that is, and as you know, it's I think one of the hardest things in launching a firm is actually coming up with a firm name that's unique, that is not already in use, that actually has the domain name in use. And so the backstory behind it for Manuka is my wife and I went on a trip to New Zealand and Australia before we had our first child. And there's a tree called the Manuka tree on the North Island of New Zealand. And the indigenous people, the Maori people of New Zealand, actually use the bark and everything from that tree as kind of like ailments and healing properties, and kind of providing peace is what they believe. And so I felt like that was the perfect fit. It's kind of what my overall goal is to provide clients, is with kind of the cheesy peace of mind that you see a lot of advisors say, but that truly is what I'm trying to deliver, is to kind of relieve some of the stress that people are feeling, especially as they transition to retirement, and hopefully have a trusted advisor for that. So.
And on the practical side, Manuka Financial was still an available website that you were able to get.
Exactly. Yep. Absolutely. That was a key part of it. So
that's what I tell people. In trying to come up with the name of my firm, I went through, no joke, probably close to 100 different iterations of various names, all the sort of typical things you would think of when trying to name an advisory firm. And the limiting factor was web domain availability. Just everything you can think of in the normal sense of advisory firm names was already taken up. So I had to really dig down deep and get creative with coming up with a name.
Yeah, there's over 300,000 financial advisors. Obviously, not all of them have their own firm, but that means you're going to have a lot of different good names already taken out there. So
definitely, yeah. All right, so you gave us some backstory. Thank you. Now, you do retirement planning. That's your focus. How and why did you end up getting kind of squarely focused on the retirement aspect of financial planning?
Great question. So it actually goes back to college for me. My freshman year of college, my dad was actually laid off from his well-paying job, and he was in his early 50s. And he's now retired. My mom is now retired. They're in good shape, really enjoying retirement. But during that time in his life, it was really a struggle. It's really hard. Hopefully it's better now, 20 plus years later, but there was obviously age discrimination, everything else. And once you lose your job, and at least from what I saw in your 50s, it can be really hard to get back to anything close to what you were making before.
Yeah.
So he had to actually work away, from home, a couple of states away, had about a 7-hour commute roughly. He did that for several years before actually going back to school and switching careers, which I commend him for trying, at that point in his career. But seeing the impact on him and my family, it obviously made an impact on me, and I realized I needed to try to set myself up for retirement before age 50 in case something like that ever happened to me.
Right.
And so I actually set my original retirement goal at age 49 and a half arbitrarily just because of that. I was like, I just want to at least be able to retire at that point, just in case the same thing happens to me. Then soon after college, I read the book, Your Money or Your Life. It's by Vicki Robin and Joe Domingos, I think. I don't know if you've ever heard of that, but that kind of led me to follow the early retirement community ever since then. And so for me, retirement planning is really kind of a natural fit because I've been thinking about it personally for 2 decades, and how do I kind of structure stuff, now, how much do I need to save now to be able to have a comfortable standard of living, at some point in the future. And ironically, after all that time kind of thinking about retirement, I love what I do. And so I actually had a client mention to me earlier this year, it's a Japanese word, ikigai. I'm sure I'm butchering the pronunciation. I think it's close. And then it's actually featured in the Netflix series Living to 100, Secrets of the Blue Zone. So I actually saw it in there soon thereafter. And ikigai actually means sense of purpose. And it's an intersection of what you love, what you're good at, what the world needs, and what you can be paid for. So ironically, even though I've been thinking about this for the last couple of decades, I will most likely retire much later than 49 and a half by choice, because this is truly my passion, and I feel incredibly fortunate to get up and do this, every day.
Yeah, same. I never heard that Japanese term before, but I can visualize what you're saying, 4 different things where they all overlap. Like that's your purpose. That's what you, in theory, should do, right? And I feel the same, like having worked in corporate life before. I forget the 4 things you just said. One was what you can get paid at, what you're good at. Those are the 2 things that intersected for me. The other ones, like the enjoyment, does the world need it, whatever, like that wasn't there. And I realized this isn't sustainable. And yeah, like you, owning my own advisory business now, truly love it, truly passionate about it, gives a sense of purpose. Yes, you can get paid at it, obviously. And people need it. And so it's like, wow, it just, all the stars aligned. And like you, I don't see me ever retiring per se, unless my mind and body forces me to. But otherwise, like this really energizes me. And I, get the impression you're the same. Like this is your calling to not sound cheesy, but yeah.
I mean, I'm excited for Monday. I truly am. I miss my kids when they go to school and everything during the day, but I'm truly excited to get back to this on Monday morning, and I'm thinking about it over the weekend still, on various client scenarios. So, and just take a quick step back too, to go a little bit about my practice. It's so, it is focused, here or based here in Richmond, Virginia. I work with clients just like you, Andy, virtually around the country. Probably 3/4 or so of my clients are actually not here locally. I work with about 45 families at this point with a goal of, right around 50. Obviously, we'll need to reevaluate that once I get there. Manage a little bit over $100 million. That's not that relevant because of the whole flat fee only structure.
Right.
But average client net worth is about $5.5 million, with about $4.5 million in investment assets, but with a very wide range. Some as a little bit under $1 million to as much as $35 million. Now, for anyone listening, I'm not looking for new $35 million client relationships. That brings a whole different complexity and everything else that you really need to think about. And that's not where the flat fee is really great at serving clients at that level. I think a fixed fee arrangement can still be very good. But, really at this point, I feel like I kind of do my best work in kind of that $2 to $10 million range, which I'm sure is where your sweet spot as well.
Yeah. Yeah. So you are a flat fee. I know we discussed this offline before, but for those folks listening, you're flat fee, but it sounds like you do have some flexibility on the periphery, like if someone were to have 30 something $million.
Yeah. And I mean, it's flat fee works great, which I think it's the worst thing to say is, but we're serving a homogenous group of clients. If all your clients you're kind of working on the same things and providing the same level of service, I think it really, really works well. Where you start to get a little bit off is when people have additional complexity needs, where you're having to spend a lot of additional time researching, making sure they're actually making the right decision. And so you have to, if you're going to price it that way, I think you have to be a little bit flexible on those peripheral things, as you kind of mentioned. But it truly is providing comprehensive financial planning. I think that's where the relationship should be focused on. Investments are just some piece. So I'm reviewing employee benefits, cash management, education planning, debt service, estate planning, and wealth transfer. With their attorney. I'm not an attorney, so I'm not drafting wills or trusting like that, but I review them on a regular basis, and certainly provide feedback on that. Looking at insurance and risk management. I don't sell insurance, but still, absolutely looking at life, disability, long-term care, which we'll probably talk about here later in our conversation. Reviewing liability coverage. So umbrella coverage is a topic, that I like to really focus on, because so many people don't have that additional liability protection. I just had jury duty last month. And fortunately I was exempt from serving, but I still had to sit there for the 4 hours during the jury selection. Yeah. And then when I was sitting there, I won't, give any details about the case, but I was thinking, I am really glad I have an umbrella liability coverage in case something like this happens to me. And then obviously focused on retirement planning, income tax planning with my CPA background, investment allocations, and other financial items as they arise. The goal is really, as I'm sure you are, Andy, it's really to be that independent third party for all things financial.
Yeah. So. And I'm speaking to the choir, preaching to the choir, but the tax aspect that you mentioned, the fact that you're a CPA, you do have such a strong tax background, tremendously valuable. And you're one of the earlier folks I touched base with as we were both starting our journeys of creating our own firms, and realized, man, this guy's sharp. And the taxing I really like, and I know clients obviously really need and appreciate. So it's good to see that you are able to take a formal sort of proper tax background, education, CPA credentials, and parlay that into practical usage for individuals and consumers who really want and need good tax service. Tax planning as part of their retirement planning.
Yeah, and the same thing for you, Andy. I mean, you're preparing lots of tax returns every year. You have, your EA credential. I mean, as you know, there's very few financial decisions out there that don't have some kind of tax impact.
Right.
And you can know it in theory, but to really have lived in it day in and day out and
right.
see the true impacts on it, it can make a huge difference for the guidance that you're able to provide, and really kind of fleshing out, all right, yeah, this may make sense, but if you can maybe achieve the same thing doing this and save you, X number of dollars on your tax return this year. Or even just reviewing client tax returns, can be hugely helpful. So
yeah, there's no shortcut to rolling up your sleeves and getting in the weeds with understanding, at a minimum, looking at and dissecting tax returns. You don't have to do them necessarily, but there's no shortcut to knowing them well. So
yeah.
All right, moving on to the sort of general questions about things. What do you think, or what do you see as an area of retirement planning that many consumers overlook or don't give enough focus to?
Yeah, I think there's probably two areas. The first is personal spending. Everyone's kind of focused on wanting to retirement, but everybody has different resources available. One person can retire completely comfortably on $2 million, whereas another person, that may last them 3 or 4 years, right? Just if that, depending on their lifestyle. So it really, really goes down to what's your current standard of living, and then what do you think may change in retirement? Do you plan on traveling more? Maybe you don't have much time to do a lot of traveling, but you want to go, you want to spend a month or two a year somewhere else, whether that's outside the country or traveling around the US. Maybe your commuting expenses are really high, or you spend a lot of money on clothing that's related to work, and those things will go away. So it's really kind of figuring out your budget today, but then also reflecting on what is your potential budget tomorrow. The other section, I think, is potential lifestyle changes. Everyone's focused on, maybe you hate your job and you just can't wait to no longer have to wake up, to your alarm clock and actually get up and commute to work. But if you work 30, 40, 50, 60 plus hours per week, what are you going to do with all that time? It's a lot of time to fill. And how are you going to replace your lost work connections? What will motivate you to get up in the morning? Do you have any kind of passions out there or hobbies? How do you deal with your loss of identity? A lot of people, the first thing a lot of people ask when you meet a new person, at least here in the US, is, hey, what do you do for a living? And what are you going to answer? Other than retired, what are you going to say for that? Have you tried it out? I've talked to people in the past that, want to spend a year or two, on an RV. Well, have you ever rented an RV and spent like
Right.
a weekend, or a week or a month or whatever it is, or some shorter time frame? Because that may be perfect for you, but it may get really old after a couple of weeks. And the last one I'll mention is I had a client tell me, this was years ago now, but does your retirement date coordinate well with the weather? And this was a person who just loved being outdoors. He retired, I think, like the very end of the year, going into January, and he's like, Mike, I'm miserable. He's like, I'd rather be going to work right now than he's like, I don't want to go outside. It's like rainy and dreary and everything else. So his suggestion was, he's like, make sure you tell people, moving forward to at least think that through. If you're, a seasonal person, or maybe just plan a trip to like Florida or something like that too, to celebrate. Right. So.
No, those are great. And I fully agree with all of them. I think a lot of people do overthink or overlook that. Many people, and it's not their fault, their retirement planning is, I don't know, I read some article on CNBC that said I need $2 million by the time I'm 65. And, what stock should I invest in? Like that's retirement planning to most people. But what you said is so much more impactful and is really going to help determine whether or not retirement's a success, whatever success looks like to people. But it's not just about how you invest and what your nest egg size is. There really is so much more to it. So thank you for that. Sure. Flip side of that question, what do you think something is an area of planning that people spend too much focus and attention on?
Yeah, same. Two things for that too. So first is investments. I think so many people are focused on investment returns and just worried about their portfolio. That's just a small piece of the overall puzzle. And you don't have to have a complicated portfolio to have a successful investment experience. I'm sure we'll talk more about that here later, but none of us have any control over the market. And from my experience, the more you watch it, the more you're likely to react to it. Yep. And the more you react to it, typically does not work out in your favor. Some people may get lucky and be able to consistently get lucky over time periods, but most people that I see that are reacting to market noise or whatever is going on tend to actually underperform just a broad-based index. The other thing is health insurance. I've come across a lot of people over the years that literally are still just working just to keep that employer health insurance before they're age 65 and eligible for Medicare, or a spouse is age 65 and eligible for Medicare, maybe still working past 65 just to get their spouse there. But there are a lot of other options out there to consider. I mean, if you're close to retirement, close to age 65, COBRA is an obvious option. Maybe there's opportunities to do part-time work and actually get health insurance coverage from that, or negotiate health insurance coverage for that. Going on the healthcare exchange or the ACA or Obamacare, or whatever you want to call it. Surprisingly, that can actually be very affordable for the right person. And the right person doesn't necessarily mean someone that doesn't have assets. Because I have certainly seen clients, approaching $10 million in assets and basically having a negative tax rate in retirement because of the premium tax credits they're getting when they're on the exchange. So if you have control over your income, that can be huge, and it may not cost you as much as you think. You can do accelerating income and all that kind of, there's a lot of strategies around it, at least under current laws. So I would, anyone that's working just for that, I would certainly encourage you to look at the other alternatives out there, because it may not be near as bad as you think.
Yeah. And I like how you said under current laws, like all things related to tax planning, you have to always give that caveat, like current laws are always subject to change.
Yeah, well, especially the premium tax credits.
Oh, yeah.
I don't know if you remember, Andy, they had like that subsidy cliff that used to go away if, I think it was a couple making like over $65,000 worth of income. So I'd literally have clients that were receiving, I don't know, $12,000, $15,000, $18,000 a year in premium tax credits. If they made one extra dollar, it'd be zero.
It goes away.
Which is insane. So right now, that's not the case. It's actually, basically phases out at, roughly 8.5% of your modified adjusted gross income. Big picture, all you need to worry about is that may all change January 1st of 2026, just like a lot of the other tax laws out there. So just something to be mindful of. We can always make the best advice that we know under current laws, but you have to be flexible in your planning. So
definitely. All right, next question. Now, these questions may seem sort of random, but just to reiterate for folks listening who didn't already know, most of these questions were crowdsourced from like the Facebook group, Retirement Planning Education, and I asked, what questions do you want to hear asked of other advisors to get their input on? So I'm kind of, it seems like I'm bouncing around. That's why these things don't have neat segues necessarily. But next one, what are some major differences in retirement planning for single people versus couples?
There's a number of them. I treat everybody differently, whether they're, a couple or an individual, but still there are things you need to think about on the peripheral of the relationship. For example, Social Security optimization. You're trying to optimize potentially for one life instead of two, and that can bring, a whole different set of calculations that come along with that. Long-term care planning. The biggest risk that I see for long-term care is really couples. You need to worry about the other spouse if you decide to self-insure and run down your assets, right? If you're otherwise, have a really comfortable retirement and you have one spouse that has Alzheimer's or some kind of dementia, needs to go into a memory care unit that's, $100,000+ per year, and you're in there for 10 years, that's a lot of money that you're spending in addition to your other spouse who's still living and hopefully still being, enjoying their retirement. I think that's a really big one that I think a lot of people don't necessarily think about, is thinking about the other person, not necessarily just you. The estate planning exemption. So, excuse me, it doubles for couples at about $27 million today. Again, that's also potentially going to change here in 2026 and get cut roughly in half, versus $13.6 million for individuals, at least at the federal level, and obviously states have their own exemptions. So that's something else to think about. And the last point is, couples may end up in a higher tax bracket if there's only one of them still living. So let's say there's a big age disparity between the two of you, and the younger spouse may live 20+ years when they're single. Well, your income may not get cut in half. Hopefully it's not getting cut in half. So you might be solidly in the 22% tax bracket today, but easily in a much higher tax bracket in the future. And so that may be a reason to at least consider accelerating some income while you're both alive, just so that the other person doesn't get, hosed down the road.
Right. Yeah. Agreed. Those all make sense. There's a term thrown around to describe that called the widower tax penalty. Now, I received some interesting pushback from people about that, who said it's not a penalty, it's that single people sort of get shafted to start with, and married couples are given excess benefit, if you will, so that you're just removing that excess benefit, bringing it back down to the shaft that single people get. Oh, yeah, that's, perspective and framing, I guess, really dictates how you view it. But that aside, the math is what it is. When one person dies, tax brackets collapse in half, and, it could have adverse impacts. So.
Yep, absolutely.
Yeah. Do you think many, all people could potentially do their own retirement planning?
Yeah, I think absolutely some, and maybe many. What you really need to have is the time, the desire, the temperament, and the knowledge. Some people absolutely have all four. Ideally, if you're hiring an advisor, they should have at least all four of those, right? I mean, probably not every advisor, unfortunately, has all four of those. But I think you provide such a wonderful opportunity for people to learn a ton about retirement planning, a ton about retirement education. I think that really does provide a great avenue. And there's so many other good YouTube channels and other stuff where you can really try to learn it if you have the desire and if you think you can kind of manage your own investments. I bet a quarter of my clients I work with could actually do their own retirement planning, but they still choose to work with an advisor because they want to make sure they don't make mistakes, especially as those dollar amounts get bigger. When you think about it, you're hopefully retiring just once. Whereas Andy, like you and I are seeing this literally hundreds of times over the years, and you get to really see what works and what doesn't and kind of fine tune the recommendations that you make. I also see kind of DIY investors and planners also want somebody in place for their spouse if they lose mental capacity, just kind of preemptively getting that in there too. But I think people can absolutely do it. I think the hardest thing is just switching from accumulation to decumulation stage or distribution stage is very different from a planning and emotional standpoint. So even if you don't work with an advisor for a long term, I think it can be really helpful to have somebody at least do a one-time plan or something like that, right? Just to give you some more confidence in that as you transition.
Yeah. Well, that all makes a lot of sense. Now, for those that are interested in finding an advisor, whether it's for a one-time thing, some other limited engagement, or ongoing, what questions should they ask, things should they look for, et cetera, in trying to help help themselves find someone?
Yeah, if you just go Google, best questions to ask a financial advisor, I'm sure there are tons that come up. NAPFA, the National Association for Personal Financial Advisors, they have a good questionnaire. I think they have a short one and a long one. I've only been asked the long one once in my entire career, and it's long. It's like three pages long, unless they've refreshed it. And there's great resources out there. But I actually wrote a blog post, I think it was December of 2022, on some of the less common questions that I think are still being important. For example, how many clients do you work with? Some advisors work with hundreds of clients, like 400 plus if you're at a bigger firm. Maybe that's fine with you, maybe that's not. Again, Andy, you and I are kind of focused more on that 50-ish or so, providing a high level of service to a more limited number of people. What happens if you get hit by the proverbial bus? Not a big issue if you're at a big firm, probably, but again, if you're at a smaller shop, or in my case, I'm a solo practitioner. I do have a contingency plan in place, but that's something that you can certainly ask. Again, I don't think it's a deal breaker, but you should just at least be aware of it. Do you have your own financial planner? So I actually went through a tough personal time, lost a close loved one a couple of years ago. And that really made me reflect on, hey, hopefully I'm going to live to age 90 or 100. Everything is in great health, everything else. But I want to make sure, if not, that my wife and kids are in really good hands, if not. And so I've kind of gone through that process and hired my own financial planner just in case, and just to have it. So I actually have experienced it from a client side too. What's your investment philosophy? If you're someone that really wants to be moving in and out of the market, as it, goes up or pulls back or whatever it is, make sure that your advisor is aligned with that, because some are and some are absolutely not. If you want a passive investment philosophy, you probably don't want someone that's going to be trading your account hundreds of times per year, right? Getting the trade confirmations in your email every day. That may drive you crazy. What fees will I incur working with you? So hopefully their fees are very transparent. We could probably have a whole podcast. I think you recently did, just on fees in general. So
I did, yeah.
so if you're interested in that, go back and listen to Andy's podcast on fees. I'm with Andy. I don't think there's any perfect fee structure. They all have their own issues, but I think the most important thing is that transparent to you? And can you actually convert that to a dollar amount? What are you truly paying for the advice that you're receiving? Do you manage, or do you allow clients to manage their own investment portfolios? Some clients are really big into getting into it and like really enjoy actually executing the trades, and they just want someone to help them with the strategy. I do allow that. That's not the norm. So most advisors kind of want to take over investment management, which honestly would save me time in some situations. But I do work with a few clients that actually want to manage their own portfolios. Again, not a deal breaker, but you should just understand that. What credentials do you have and what do they mean? There's a plethora of credentials out there across the board. Some are more meaningful than others. Do your research on the advisors that you're interviewing and seeing what they mean on your own, but you could also ask them. And the last two are you a fiduciary all the time? Always act in your best interest. I think that term tries to get watered down over the years, unfortunately, as I won't say the regulatory entities that are working on all this stuff, but there are trying to make advisors more closer to fiduciary, but I think that actually waters it down for the ones that truly are acting in best interests. Yeah. And lastly, do you work with clients like me? Ideally, you want an advisor that understands your situation, has done this before, and can provide a lot of value to you, and is not missing something just because they're not doing it on a regular, serving a client like you on a regular basis. So I know that's a lot, but those are the ones that I think are a little bit more unique that you may not find on a standard list.
Yeah, those were great. I especially like the last one. Do you work with clients like me? There's a lot of advisors out there who, if you can fog up a mirror, you're an ideal client for them. And that's the only qualifying criteria. Like, you want someone who specializes and truly knows your particular areas of need and interest out of the relationship, not just a generalist who, again, will take anyone who has a pulse. So great list. Yes. Now, this next one's a fun one. The value in an advisory relationship. What's your thoughts on whether or not the value can actually be measured?
Yeah, so I actually think yes and no for this one. It's actually not uncommon for me to be able to provide value. Now, it may or may not be, measurable value. It may or may not cover my fee for various situations that you might find for trying to optimize. And I can give a few examples here in a minute. But these are more kind of the quantifiable examples. So, for example, cash, first question for cash is, do you have too much? A lot of people have too much right now because cash is paying 5+%. It feels great, right? It's not fluctuating. And as of right now, you're actually beating inflation on cash, which is not normal from a historical perspective. If you don't have too much cash, where's the best place to put it? I'm just thinking of a client earlier this year that came on board, and just kind of looking at their financial situation, the cash that they had on hand and where it was allocated. For this particular person, I think it was $22,000 per year of net after-tax yield just from still maintaining the same amount of cash. Now, for their situation, they're going to be buying a house and stuff like that, so they had quite a bit there. But I think you can really provide a lot of measurable value for that, and often, sometimes even more than the actual fee that our clients may be paying us. Another example might be some kind of tax strategy. For example, like you may or may not have heard for any of the listeners out there, like quote unquote charitable lumping. And gifting appreciated stock to a donor advised fund. So lots of people, gift on a regular basis. Let's say you're gifting to your church and you're giving on a monthly basis to your church, and maybe you're gifting cash, and just taking the standard deduction because it's been so high for the last number of years since 2018. Now, literally, for a lot of clients in that situation, we're stopping to gift cash. We're gifting appreciated stock to a donor advised fund. Typically for multiple years worth of gifts, that gets you over the standard deduction. It allows you to itemize, get a tax deduction today. And then you're still doing the exact same thing, and you're gifting cash from the donor advised fund to your church or any other charities that you're trying to support. I mean, I'm sure you've seen this, Andy. It's not uncommon to save somebody $10,000+ on something like that, on a strategy like that, if for the right person in the right situation.
Right.
And another example might be like missing U.S. obligation interest. So have a situation, I've wrote a blog post about this too, and I think Andy, you and I have talked about it, but Charles Schwab and other custodians don't actually report U.S. obligation interest that's embedded or derived from mutual funds or ETFs. They do if you're investing directly in treasuries, but it's not on the 1099 for some of these large custodians. And a particular client switched over to me last year and reviewed the last few years of tax returns, no U.S. obligation interest, and they're in a high tax state, and they had a lot in bonds. So I thought that's strange. So kind of looked at literally every single fund and calculated it out, and I think that client, it was, I don't know, $20,000 maybe, that they were able to go back and actually amend the last 3 years of tax returns. Now that's much larger than that would normally be. This is not a typical situation that I come across, but it absolutely is something that you should be looking for. And if your advisor isn't knowledgeable about that and or not communicating it to your tax preparer, who may not even know to look for it because it's not a 1099, that can be a measurable value, tangible value.
Yeah.
But then you have things that are, like having a more efficient investment strategy or implementing Roth conversions. You can estimate that kind of stuff from a tangible value, but it may take many years or decades before you can actually measure the results. And then all of that's subject to tax law changes, as we talked about earlier, in the podcast. Stuff's going to change. So we can estimate those kinds of takeaways, but it's an estimate, right? And it may or may not actually materialize down the road on how much that actually saves you. And now I'm obviously biased, but outside of those measurable or immeasurable values, I think there is so much more to having someone that you trust to help you make financial decisions, who is an independent third party. I mean, I've seen it in my own life with my wife and I, and bringing us together and kind of forcing us to talk about our goals and objectives, and really trying to help us come to agreement on situations and really focus on the future. Or having someone to, as I mentioned, in place to make sure that your loved ones are going to be well cared for after you're no longer here. And for a lot of relationships, you might have one spouse that's really into the day-to-day finances and another one that wants nothing to do with it. That's not all the time, but that certainly happens. And for the person that knows what's going on, it's nice if you can kind of unload all that information while you're still a living and competent, in case it needs a transition to an advisor for your spouse at some point in the future. And I don't know how you truly value that in actual dollars. I think that's completely subjective and worth a lot more to some than it is to others.
Exactly. It's not possible to put a dollar amount on it, but it is truly immeasurable to lots of people. Other folks may not care much, if at all. And then every spot along the spectrum in between, there's differing levels of value people put to it. So
absolutely.
Great answer. What sources do you use to learn and stay up on retirement planning related stuff? Blog. And I'm not asking you to pitch my stuff here, but like you can exclude my things. But what else do you use? Blogs, podcasts, YouTube channels, etc.
Yeah, so I will absolutely put in a plug there for your stuff, for your retirement planning education Facebook group. It's phenomenal if anyone wants to join. I mean, there's probably 60,000 members at this point, Andy?
Getting close, yeah.
Yeah, and I'm guessing 98% of those are real actual people, as you guys do such a good job trying to eliminate the bots and the spammers.
There's definitely some fake profiles and bots still in there. We're trying to get them out, but yeah.
Yeah, this podcast is obviously great. If this is your first time listening to it or one of your first times, go back and look at the real retiree interviews, especially for, me as an advisor, are fascinating. I love listening to someone on that. It's getting a really in-depth dive for how kind of they've thought about it and approach to retirement. It's really, really helpful to get, I think, insights into that. Mastermind / study groups. So you and I are in a mastermind group together. I love that. I love having kind of the camaraderie around that and getting different viewpoints around the country for people that serve different clients. It's a lot less actual groupthink, and a lot more diverse, opinions that can really help you think through, oh yeah, well, I never thought about doing something this way. I like that. Outside of that, I would say Michael Kitces is huge. The value that he provides and content he provides. As I mentioned, I've been following the early retirement community for decades. So there's the Mr. Money Mustache out there, Pete Adney, Choose FI. It's actually based here in my hometown of Richmond. Early Retirement Now, Wealth Logic, Alan Roth. Andy, I think you're probably familiar with Alan as well too. He has a monthly newsletter that's really good. And the last one is David Holstrom of Financial Architects. He has an excellent quarterly newsletter for financial professionals, as well as other resources on his website. I haven't heard anybody yet, I think, reference that before, but really, really sharp advisor. And I think he actually used to teach the CFP courses. I'm not sure if he still does. That was 15 years ago when I heard that. So
I don't know that. I'm a member of Financial Planning Association, and they have their own sort of member message board chat room, if you want to call it that. And David Holstrom is very active. I've crossed paths with him in a good way multiple times over the years, and super, super sharp, super quanty guy, almost a little too much, but it's clear like he really knows and really thinks about this stuff thoroughly. So I'd be curious to see his newsletter that you mentioned.
Yeah, if you ever want to do a deep dive into numbers, highly recommend looking at some of like his spreadsheets and stuff that he builds. And if you really, really want to quote unquote nerd out on retirement stuff, that Early Retirement Now, the author goes by Big Earn, which I think he now has released his real name now that he's semi-retired. His name is Carson Jeske, if I'm pronouncing that right. But he has it's called like a 50-part series on like the safe withdrawal rates, which is a fascinating read if you have days of time of free time to actually go through and understand it. He is super into the weeds, but it's really interesting just to read his perspective and going into all that. So
yeah, good. And I'll link to all these different things in the notes here so people can check them out.
Perfect.
All right, moving on to some things specific to you and your practice and how you go about implementing things. So how do you know if someone is a good fit for you as opposed to just you being a good fit for them? So this is a mutual relationship, right? Both parties. It's not like most big household name places where, again, they'll take anyone with a pulse. You want to ensure clients are a good fit for you and what you do, and not just that they're willing to hire you.
Yeah, number one, are they nice, or are you nice?
Right.
It sounds stupid, but if we're going to be working together and communicating on a regular basis, I really want to enjoy working with you and be excited to answer your email and not like, oh no,
yep,
Andy emailed me again, in all caps.
He's the worst.
Looking for a long-term relationship. There's no strings attached ever with working with me or my firm, but I truly am looking for clients that are looking for it for the long haul. If you're ever not happy, you can leave at any time, but I really do think there's a lot of value in having that longer term relationship and getting to know somebody, so that when times are tough, I kind of know where you're coming from and can help. Everybody comes from a different background. I want to be able to understand where you come from and how can I help you in those tough situations. Ideally near retirement or in retirement, but it could also just be financially independent and just want to continue working in some capacity. And I can relate that to it personally for me, given my my retirement / working goals. And so that's just interesting to me, and so I want to take on people in that role as well. But really, can we develop rapport? Do you have a sense of humor? Hopefully. And that to be great, but with some sense of humor and enjoy working with you. I think those are like the three big criteria that I look for. And as you mentioned, Andy, it's it's really nice being able, selective
Yeah.
and having a small, number of clients versus having hundreds and having to just take on literally anybody that meets your asset minimum or whatever it is.
Right. When you don't have the boss man breathing down your back and you have to hit a certain production goal of bringing on X new relationships or bringing on X amount of new assets, and you can pick and choose. Now, granted, you still have to live life and make sure you get paid accordingly, but you get to a point in your practice where you can be selective, and it's a good thing to make sure that you're filling up. The analogy is like there's only so many seats on a bus. For every seat you fill with someone who's not the right fit, you're crowding out the seat for someone who'd be a better fit otherwise, right? So
and
it takes intentionality.
Feel it. Yeah, when you have a smaller number of clients and someone is not a good fit, you feel it really early on. Like it's pretty obvious. I used to call them, wouldn't take on a client that has any red flags. Well, I now have yellow and red flags.
Right.
just things to watch out for. Because a lot of those things, if it's in the first time you talk with them, if it's something doesn't feel right, it's definitely not going to feel right. The longer time goes on, most likely in most cases. So
yeah. And this is a good tie into the next question. And like you said, when it doesn't feel right and it's not just because they're a bad person or they're not funny, they don't have a sense of humor. It's like their needs or their situation or circumstances might not fit well within the realm of what you want your focus to be and to remain. And so like the planning needs and some of the considerations around it might be outside your comfort zone, for lack of a better, not you in particular, but just like in general, I'm just thinking out loud. From my perspective, it could be like their circumstances and scenario is just not a good fit for what you're trying to build your focus on. So anyway, with that in mind, have you ever had to initiate parting ways with someone? I don't want to call it firing necessarily, but because that has a negative connotation, but part ways with someone and why, if you're willing and able to share.
Yeah. I am a non-confrontational person. At least I try to be. So I do not love trying to part ways with someone. So typically, if we're going, if the relationship doesn't seem like it's going in the right way, I really am going to hold my ground on my position, the position that I'm taking, and hopefully that will allow them to self-select out, whether that's upfront or, if we find out whatever it is just isn't working, just having a conversation. I don't want anybody paying me that is not getting value for the advice, for value of my advice for what they're actually paying me. I don't want to be dead weight on anyone's, expense statement or like that. Typically what I found, and it's been 14 years, so I've seen a lot. I think the biggest thing is an incompatible investment philosophy. So if someone says, "Hey, I'm absolutely on board with low cost index and everything else," and then 6 months or a year later, I'm like, "Why did you not get out of this and buy this?" I'm like, "Why did you not do this?" So anyone looking for market timing or, had a client that wanted hundreds of stocks, never heard of hardly any of them, and wanted to move over to passive investment strategy, and we move everything over, and then, oh, wait a second, actually, I want to keep all of these, and can you, run a regular analysis of these positions? It's like, well, that's not where my value proposition is. Like, so that kind of stuff, it tends to weed itself out. I do my best up front, but if not, it's usually evident pretty early on, I think, for both parties, hopefully. Yeah. And because you don't want to be paying someone that you're not that you don't value their advice. Just go find another advisor. There's, again, as we mentioned, there's hundreds of thousands of advisors out there. I'm sure there's someone that's the right fit for your individual situation. Yeah.
And it's also important, and I think this is common with a lot of us smaller places that are truly in this for good reasons, is when you do hit the point where you realize, okay, this relationship it's not best if this moves forward, unless the person is just an outright rude, terrible individual and you just got to get rid of them. It's important to help them try to find someone appropriate and not just be like, "I'm not the right person, sorry, here's your money back, go away." I think we owe it to people to help them find someone who is a good fit. So that, that's the other sort of side of this.
Absolutely. And especially, if somebody has a super complicated estate, that's one thing that almost, I do my very best to not take on.
Yeah.
I do have other advisors out there that love that stuff, that do that day in and day out, and I absolutely will, say, hey, I'm not the right fit, but here's so and so, recommend you go talk to them. I think you're absolutely right. If you're in it for the right reasons and you truly do care about the people that you're working with, I think it's you said it perfectly. It really is nice to be able to hand off, to someone else that you feel confident will provide a good, be a good service to that person.
Yeah, no doubt. All right, investment management. We've already sort of gotten into this, but what's your view and approach with how you manage investments for clients?
Yeah. So, I'm forgetting the name of the book. I think Psychology of Money. Morgan Housel, who wrote it, he has a great quote in there that I actually have on my website with, accrediting to him. But it goes, a good definition of an investing genius is the man or woman who can do the average thing when all those around them are going crazy. And I think that's perfect for our investment philosophies. It's absolutely a passive, low-cost index approach with global diversification, especially on the stock side, bond side too. But I think the bond side, there's a little bit more nuance there. I use some individual treasuries into our tips when it makes sense. Truly trying to match up, duration of bonds versus expected need. Again, I'm not using anything that's expensive or like that, but really trying to think through, all right, bonds are there for a reason. It's the anchor of the portfolio or to fund, X, Y, and Z. Let's make sure it's going to be there when that happens. Because as we experienced in 2022, the market was not favorable for the U.S. aggregate bond index. If your duration is 7 and you're spending the money right away, it's a little bit harder to stomach that when you see that going down. So not only from a return standpoint, but I think it can be really helpful just from a mental, emotional standpoint to have those bonds kind of lining up at least a little bit to that, or having, more in short term if you're going to withdraw sooner. And then obviously with the CPA background, same thing for your, EA and tax background, Andy, is, focusing on after-tax returns whenever possible and whenever feasible, and really trying to maximize that as opposed to just trying to get the highest yield.
Right. Definitely. Speaking of investments portfolios, your benchmark sort of passive-ish approach shop. Do you do any sort of benchmarking or show clients, here's what your portfolio returned, here's what this, that, or the other index or benchmark returned?
Yeah, I do not benchmark any of the portfolios. I tell clients, look, we're investing in the index itself.
Yeah.
If we're in the total international stock index, right, you're going to get international stock returns. That benchmarks returns, plus or minus a few basis points for fees and index tracking errors. I do absolutely look to make sure those funds are tracking the appropriate benchmark that we're trying to track and making sure they're not too off kilter for that. I do absolutely review performance of each account, client's account periodically. If one's way off compared to where it should be, why? Do we have higher cash for some reason because of upcoming distribution need? And clients have access to review the performance at any time. They have performance reporting software. They can log in, run it any time period. They can look at year to date, last 1 year, 5 years, last week, how did it do at any time. So I try not to focus on investment performance because I don't feel like that's the huge value in the relationship. But I do certainly allow clients to look at it at any time, and we can obviously talk about it if they ever want to.
Yeah, and I think that's important for people to let sink in out there. Folks like Mike and I and other firms like us, we're not trying to hide anything or like fleece you by not bringing attention to benchmark returns, or here's what the S&P did, here's what your portfolio did. I don't say it doesn't matter, but almost doesn't matter. Like you said, like if you're invested in the total international stock fund, the total US stock fund, let's just keep it super simple, that's it. Your returns are simply that. Your returns are that of the benchmark. The only difference amongst clients and amongst accounts is how much did you have in A versus B, or in stocks versus cash. Like that will all those levers will change what your return is. But you are getting index returns, like you said, minus a little fraction of a percent due to fees and tracking error. Where it matters is if there is someone who pins his or her value on trying to outperform the market and says, we will consistently beat the S&P 500, they better show you regularly, here's what the S&P did, here's what your portfolio did. If they're not consistently always better than the S&P, that they're flat out failing at their stated objective. So then you have to benchmark. In our case, it's really not necessary. If anything, it's a distraction for people to focus on and get worried about wrong things that don't really matter, if that makes sense. Yeah.
No, you're absolutely right. I mean, there are absolutely firms out there too that they have quarterly performance review, quarterly meetings, right? To review performance for the last quarter. Now that is such a short time horizon.
Right.
It's really, I mean, as you mentioned, if you're hiring a firm solely for investment performance, it does make sense. But for, it's for Andy and I think, and lots of firms like us, it just doesn't make sense to actually do that. Again, happy to talk about it, certainly bring it up, we can go through it, everything else, because it's obviously, the returns you get are important, but it's not the most important thing that, at least in my opinion, that you should be focusing on.
Yeah, and just a quick side note for those who do hire firms that are really just investment focused, and they will hopefully show you benchmark and compare your returns to that. They can always change and massage the benchmarks. I've saw it so much in my prior corporate life where I'd analyze hedge funds and private equity funds. There's so much manipulation, sounds too dirty of a word, but they'll change their benchmark over time and say, oh no, we feel like we're changing our portfolio to have a bias towards this now, so this benchmark is more appropriate. Oftentimes they're just backing into and massaging the benchmark that makes their returns look good because the previous benchmark they were using didn't. So take it for what it's worth, but I wouldn't put too much faith and value in the benchmark someone uses, or if they use it, make sure they use it consistently and don't change it regularly. But
absolutely.
Right. Annuities, hot topic. What's your view, usage, thoughts on annuities for clients?
Yeah, probably a lot of firms in our space that are trying to be as unbiased as possible. I generally don't like them just from lack of flexibility and the additional complexity that they can bring. Now, I certainly think they can be appropriate for some people in some circumstances, especially if someone just can't stomach the market volatility. An annuity might be great for you, depending on what kind of annuity that you're looking at. But it's incredibly rare that I recommend them to any clients that I work with. Some of them may come to me already having them in place, and we keep them there and figure out the best time to annuitize it or do something else with those funds. But generally not recommending them outside of, the exception would be if it's like a company or government pension or something like that, where you have kind of the option to take a lump sum versus take the annuity. A lot of those quote unquote annuities / pensions, those can be great deals. So we certainly, want to evaluate that and make sure you're making a wise and thoughtful decision on that. But outside of that, it's, at least for the clients that I work with, it's not typically a great fit.
Okay. Same question for trust. And by this, I mean like the living revocable trust, not special needs trust, not the other sort of more bespoke trust. And I just want to preface this by saying I had a conversation with someone not too long ago, another advisor who's all in on basically everyone should have a living revocable trust. The next day, I was walking outside my office, and the estate planning attorney who has an office down the street happened to be sitting outside eating dinner at the restaurant right next door to my office. So I walked past and asked him, like, hey, and he does trust. He's trust wills, whatever, in New Jersey and New York. And I asked him, what's your thoughts on living trusts? Do people need them? He's like, New Jersey? Absolutely not. Not to say he can't get one, but his view is that New Jersey, now this is state specific, but New Jersey, fairly quick, fairly low cost to go through the probate administration process. Other states, different story. California, for example, one of the higher cost of probate. So all else equal, usually it's a good idea in California to have a revocable trust. New Jersey, not the case. Every other state, who knows? It depends. So I just want to preface that, like, there isn't a blanket answer that's going to apply to everyone here, but what's your views, usage, and thoughts around living revocable trusts?
Yeah, and I'll further caveat that And you and I are, neither one of us are estate planning attorneys.
Correct. No, we are not.
So the first option is talk with your
Right,
estate
yes.
planning attorney and not us. But I think it's completely situational. I think some people can absolutely don't need a trust when you can accomplish everything by just naming proper beneficiary designations on all your accounts. But some examples where it may make sense is, let's say it's privacy. You don't want everybody to know where the assets are going, which might otherwise be public knowledge if it's going through probate, if you don't have a trust. If you have young children or grandchildren that are heirs, that you may want to control the distributions out to, let's say you want to do a third at 25, a third at 35, and a third at 45, or whatever that is, to kind of, actually draw those distributions out so that, your heirs don't get potentially millions of dollars at a very young age when they could, unfortunately be taken advantage of. That can make, a lot of sense for that. If you're on a second or third plus marriage, it may make sense for that, because that's obviously very unique planning opportunities around that and what you're trying to accomplish for your current spouse, but maybe kids with another, previous spouse too. Another situation I've come across is if you don't trust your child's spouse. So if you're worried any of your children's spouses might spend down the assets, might try to take advantage of your child. I've seen it, parents want to put it in a trust there to protect their kids and make sure that it's going to stay with their child and be protected from that spouse, especially if that marriage ends up going awry. As you mentioned, special needs. And estate tax planning that's a whole separate issue. That's not even a ref trust, like an ILA or something like that. But again, I'm certainly going to discuss pros and cons with each client as they're going through the estate planning process. Certainly, kind of let's do some of that work up front. Let's talk about who beneficiaries are. Talk about successors. Who's going to be your successor or step in for power of attorneys, that kind of stuff. But again, I'm always deferring to the client's attorney, because they're going to have more experience and more education than I ever will, in that arena.
Like you said, we are not lawyers, nor do we play them on podcasts. So,
no,
right.
No.
Same question, long-term care insurance and planning around it. You already sort of touched on this earlier on, but what's your view and approach with this?
Man, long-term care is tough. I think it's actually one of the most difficult areas to be a financial, planner / advisor. It's the current long-term care insurance market is so different than it was 15 or 20 years ago. I've had clients that 20 years ago got a long-term care insurance policy that was actually pretty affordable, that covered them for the rest of their life. Now that does not exist anymore. And for the clients that got those policies, they probably had a 3 or 4 times increase in premiums if they're still alive and still paying those premiums. So what I do from a starting standpoint is really kind of build those potential costs into the plan to at least look at it. Let's have a discussion about it, or review the current policy if they have one, and then we kind of consider the alternatives. So maybe it's max funding an HSA or earmarking a health savings account for long-term care insurance, and that's kind of earmarked for that. And just in case you don't ever need it, let's keep a list of unreimbursed medical expenses in the meantime, where you could easily just go back and take a big cash distribution, or even your heirs could take a cash distribution tax-free from your HSA if it's not used up. This doesn't impact any of my clients right now, but Medicaid is an option, right? If you spend down all your assets, Medicaid could kick in. That may or may not be the ideal place that you want to be, but it at least has funding there. Now, that is not the ideal situation if you have a surviving spouse, right? A lot of people do not want to spend down assets. You're leaving your spouse basically destitute, and therefore you're getting, essentially free long-term care benefits. Reverse mortgage, looking at that, do you have a lot of equity in your home that you could potentially have a reverse mortgage in the future? I haven't had any clients have to do that, but it certainly is a discussion point. If you've got, if you're what California rich, as they call it, where you've got a house that you paid, a couple $100,000 for 30 years ago, and now all of a sudden it's worth $3 million. That's a huge asset if you ever need to tap into it and need to fund something like this. A lot of my clients have sufficient assets, so we kind of go through, if we can literally run 10 years, worth of long-term care costs. If you still are completely fine or look, appear to be completely fine, you're probably fine to self-insure. And as I mentioned, kind of impact on on the spouse, and then in rare circumstances, even like looking at, getting a policy. But again, those policies today they're not perfect. They're really expensive. And the time horizon that they cover is just typically not that long. So the ideal policy that I've thought of for a lot of my clients would be like a 2 to 3 year elimination period where you self-insure for the average stay in a nursing home, and then you have a long-term care policy kick in. So that would be for your dementia or Alzheimer's type scenarios. But so far, I haven't found anything like this. So if anyone in the long-term care insurance space is listening to this, please develop a policy like this. There's a large market of people that I think would actually be interested in purchasing this, just as kind of that like catastrophic coverage, which is what I think ideally you want insurance for in the first place. Kind of self-insure for the smaller stuff, have insurance there, to prevent a catastrophic loss.
I think that makes a lot of sense. And this is something I struggle with a lot as well, because it's such a wild card. You have no idea if you're going to have a long-term care event. If you do, how severe, how costly is it going to be? How long is it going to last? Yeah. To your point, traditional long-term care insurance usually has a 90 or 180 day elimination period, which means you foot all the costs for 90 or 180 days, then the policy kicks in. Even then, you have like a finite pool of coverage that they give you, especially, newer policies. And the premiums I have seen in the 4 or 5 years I've been in business, like premiums can go up a lot, 20-30% per year in some cases.
Yeah.
And if you do end up having this event and using the insurance, it will have all been well worth it. But if you don't, it stings spending $2,000, $3,000, $4,000, $5,000 a year, depending, who knows how high your premium is going to get. The other difficulty is like you alluded to earlier. What if you have $100,000+ a year care, memory care that goes on for 10 years? Well, most people, like, you can't possibly plan to cover the extremes like that. Not to say it's not going to happen. It can happen. But if you plan for the worst case like that, most people just simply can't. Like, you'll be earmarking all of your funds for potential long-term care, right? Like, and that's what makes it hard. All this is potential. So I really like your idea of, what if we can insure the true tail risk? Like, yes, I'll cover the first 2 years, 3 years. If I still have an ongoing expensive long-term care event, then I want insurance to kick in, so I'm not fully depleting assets. But that's an interesting thought. I wonder why no one's come up with that yet, or if and when they will. But anyway,
maybe the market is small, because maybe no one wants to pay still a couple $1,000s a year in premiums for something they truly, there's like probably 90+% chance they're never going to use. But I would purchase one. Yeah. If it meant, my family's going to be okay, just make sure I can self-insure for the first couple of years. I'd gladly pay that to have that in place. So yeah, same. Anyway. So if you get that off the ground, let me know, because I might be interested in one as well. If you can make that happen. I will, absolutely.
Distribution planning, big part of what you do, folks in retirement, spending down assets, not just, still accumulating and saving. I'm curious to see where you go with this. There's a lot of ways to approach this, but what's your approach to putting in place a distribution plan for clients?
This is where it's really nice to have 45 to 50 client relationships. Yeah. Because I can completely customize this per person. And I think it makes a lot of sense to customize this for each person. Everybody has different resources. You might go into retirement being covered by a pension, Social Security, and or existing annuities. Well, you pretty much hit the retirement lottery, right? So there's really no distribution plan. Then it's more about thinking about legacy goals and everything else. Most of my clients are not in that situation. But there are some people out there absolutely that I've come across that, that absolutely have that situation. So for those that are not, I'm typically setting up a reoccurring monthly distribution from their taxable account to their checking account to recreate that paycheck, right? If you're used to getting paid on a, twice a month or every 2 weeks, whatever it is, just have that go in there. There's your spending for that month. I'm not trying to limit anyone to a budget, but it's just much easier to say $10,000 a month is coming in here. that's what I have to spend. If I need more, maybe I'm spending a little bit too much, or is there some things so that can also gauge spending? But also it's really kind of reoccurring, it's regular, and it almost gives you permission to spend that money, if that makes sense. That assumes they have a taxable brokerage account. Now, some of my clients don't, and so we have regular distributions from their IRAs that we're adjusting each year, based on withholding, whatever else is going on. So when Social Security starts, and you can really fund that taxable account as well from other resources. So let's say somebody has $100,000 in a taxable account. Well, that's probably not going to last them their whole retirement, but maybe we're pulling from the IRAs, distributing it to the taxable accounts, or doing RMDs or whatever else into the taxable account, and then distributing it out. So it truly is customized. I can't say one size fits all for this. I think you can simplify it, but I do truly try to look at distribution plans for each person. And then it really is helpful when somebody is retiring before Social Security eligibility and before RMDs. So there's that sweet spot. Let's call anyone retiring from like 50 to upper 60s, where you truly have a lot of flexibility on where you take your income from. And so we're trying to really think through how can we be as tax efficient at this as possible, so we don't get hosed on really big RMDs in the future and potentially higher IRMA premiums and everything else. So let's do that earlier. That's where you're doing your Roth conversions and whatnot as well. So it's, long story short, it's customized based on the person, but do try to set up that reoccurring distribution.
Now, what do you actually deliver, if anything? I've had some people ask, like in the Facebook group, I want, or I ideally would like to see from the advisor, here's this printout, here's what we're doing for the next 10 years or whatever, here's where your money's coming from, here's how your accounts are going to be impacted, et cetera, et cetera. What do you do, if anything, along those lines?
Yeah, so I start with reviewing the output from the financial planning software. So I'm literally, in a financial planning software, reviewing the details in there with clients as much as we need to go into the details. A lot of my clients, and Andy, you probably have the same thing, they are more financially savvy than the average person who hires a financial advisor. And I think a lot of that has to do with the flat fee structure and kind of how they find you through the podcast or your Facebook group or YouTube channel. But so a lot of my clients do want to actually visualize that. So we're starting with the financial planning software to run the Monte Carlo simulations and everything, stress test the portfolio as a starting point. I'm detailing out the recommendations in an email, saving a PDF in their plan, in their vault. They can look at it anytime. And then sometimes I truly am creating a separate spreadsheet for clients, especially if they're retiring in one of those scenarios I mentioned before Social Security and or RMDs, where we have some flexibility on that. And that's really to show, all right, this year we're going to be potentially in like the 22% tax bracket, but look, next year you're only going to be in 12. And so we need to make a decision on that 12. Do we fill that up to the top of the 12? Do we go to the top of the 22? And then look at it, because 5 years from now, you're going to be in 24% tax bracket, or what is 24 today, which might be 28 in the future. And I think that really helps us make decisions on, do we accelerate income? Do we defer income? And how does that actually materialize? Now, I also tell clients when I'm developing these spreadsheets, this is going to change. This is just an estimate. Your dividends and interests are going to change each year. Tax laws are going to change each year. This is just kind of the high level, what we're planning on today. Use tax planning software to actually do the true tax liability. Their needs are going to change, right? Mm-hmm. You might need you might think your roof is good for the next 5 years. All of a sudden next month, you need a new roof and it's $50,000. Well, we'll need to have some flexibility in there for where that $50,000 is going to come from. So all of it's subject to change. But I've noticed that planning software is not always perfect for laying out that distribution strategy. And so that's why I feel like Excel or some other deliverable can be really helpful to just kind of go off of that, especially for clients that have larger taxable accounts where the dividends and interest might not be calculating very accurately compared to what they're actually, the planning software compared to what they're actually earning. So,
yeah, I'm on board with that. So I think we use the same planning software, and it's as good, probably the best software in the industry, or up there at least. And it's good for longer term, sort of broad stroke, directional planning, spotting kind of opportunities, being able to visualize opportunities. But the nitty gritty of implementing, where does your money come from? What's your income each year, year by year? It's just educated guess slash basic estimates, right? Like you really have to step away from that year to years when you get in the weeds, rubber hits the road, and you map out a specific tangible dollar amount of distribution, conversion, et cetera. The software doesn't do that. Then you go to, like you said, tax planning software, spreadsheets, or whatever it might be. Tax planning, speaking of, obviously important. You and I are well aware of that, but what are some common tax planning opportunities you come across with the folks you work with?
Yeah, I would say I'll talk on the common ones because it truly runs the gamut on what I come across, and I'm sure the same thing for you. But a huge one is the charitable gifting strategies that I mentioned. So, if you are charitably inclined, and I even have clients, Mike, because the standard deduction is higher, I'm not gifting much to charity. Should I gift? It's like, well, that's on you and your own values. I'm not gonna I'm not gonna try to put my own values on you. Do whatever you want and whatever you feel comfortable with there. From a tax perspective, no, it's not making any difference, right? So if that's what you're looking for. But for those clients who are charitably inclined, absolutely looking at gifting appreciated stock, whether that's directly to the charity or donor advised funds, looking at qualified charitable distributions, or QCDs for short, which is where you gift directly from your IRA to the charitable organization, and therefore that income does not show up on, as income on your tax return. And like, Mike, why would I care if I'm just going to give it anyway? Well, IRMA and other factors are actually calculated by your modified adjusted gross income. So it actually can truly save you a lot of money from those things. But if you're taking the standard deduction, you're also getting no benefit for those charitable deductions. So absolutely use pre-tax money that you have not paid taxes on, that's been tax deferred your entire working career, and make those directly to charities. I will also say I've come across someone in the past who took the distribution and then made it to charity. That is not a QCD. You need to make sure that you absolutely gift it directly to the charity. You need to fill out a form from your custodian and make sure it goes directly, the check goes directly to the charitable organization. Accelerating income in lower income years. So that's where your Roth conversion strategies come in. It's absolutely a hot topic. I'm sure the Facebook group, when I go in there, there's probably a post every day about Roth conversions, right? It's a hot topic. It may make sense for some people, a lot of people. It may also not make sense for others. You really need to be mindful of, and again, it's an estimate, right? Because we don't know what tax rates are going to be in the future, but mindful of what is that going to impact, and what are you giving up by paying taxes today versus deferring to the future? Maybe you're in between jobs. It might be a great time to accelerate income. If you're getting ready to go on the healthcare exchange, as we talked about earlier, maybe you accelerate income in December before you go on the exchange to keep your income lower, because maybe you pay a little bit higher taxes last year to pay basically no taxes this year, actually have a negative tax rate. So plenty around that. Tax loss harvesting. So I didn't mention this on the investment side. I do actually break out in taxable brokerage accounts. I do typically break it out into a little bit more positions. I'm still targeting the exact same benchmarks. We're still using index funds, but I'm just breaking it out to have more tax loss harvesting opportunities. For example, I think a perfect example would be growth versus value stocks, right? Those have certainly seesawed back and forth over the last couple of years, and growth might be absolutely crushing it, up 30%, and value might be down 5%. Now that's a huge disparity, but that could actually happen. So you can literally have the exact same risk exposure, tax loss harvest your, whatever is down, put it into something else that's similar but not identical. There's a whole thing you need to worry about for that, which we won't go into on the podcast. But there are opportunities for tax loss harvesting, or even tax gain harvesting in low income years, if you can potentially pay zero or very low capital gains, long-term capital gains tax rate. Looking at yield on cash, as I mentioned, you don't always want to go with the highest yield, because if you invest in things that are not taxable at the state level and you're in a high tax state and a high tax bracket, you might be a lot better off investing in something that actually has a slightly lower yield because you're not paying state income taxes on that. And that's really hard to conceptualize and calculate. But I think it's something that's important, or even looking at like muni bonds. If it makes sense for you from an investment perspective to have bonds in your taxable brokerage accounts, you should be doing an analysis. Should I be investing in muni bonds or not? And just because you do an analysis at one time doesn't mean that those yields don't change, right? We've seen muni bond yields all over the place. I was literally just looking at them yesterday, I think, just from looking at clients' money market funds and like what's the most tax efficient one for that. And muni bond yields are up quite a bit, where treasury yields are actually down slightly. So I literally just switched a few over yesterday into something that's doing a higher yield. And then lastly, again, as we kind of talked about Roth conversions, but the backdoor or mega backdoor Roth conversions, especially for high income earners, you're never thinking about doing Roth conversions now, but that might actually be a great time when you actually contribute after tax contributions, not Roth, up to the total plan limit in like your 401k or other workplace retirement plan. And then you can convert those after-tax dollars to a Roth and never pay taxes on those again. So that can be a unique planning tool. It's, I think, becoming more popular and more written about, but still is something that a lot of people, I feel like, have not necessarily heard about. Could be a good opportunity if you're still working.
Yeah. And I think some people get hung up on saying, well, I'm still converting as part of that. Why would I convert and increase my income? It's like, well, you're not. You're ultimately contributing money you already pay tax on, so you're no worse off tax-wise. The difference is you're in a backdoor roundabout way, you're contributing that money to a Roth account where it's all going to eventually come out tax-free, versus if you put it into a regular brokerage account, there's going to be some element of taxability on it. So,
And that income limit the contribution limit is huge for people that don't know. Everyone thinks about just contributing to your 401k, but unless it's $30,000 right now, if you're over age 50, the total plan limits I think are 76,500 once you add on the over 50. That's a lot of money to be going in. You have to calculate the employer match or employer contributions plus your contributions, but it still could easily be $20,000, $30,000, $40,000 that you can contribute and then convert to a Roth account each year. Yeah. You do that for 10 plus years, all of a sudden you're talking about and with some investment growth, you're talking about some pretty nice, asset there that you're never going to pay taxes on again, even if you're in a high tax bracket. So,
right. And if your plan allows it, you touched on this before, but like not everyone can do this. You have to have an employer plan like a 401k that first allows after-tax contributions, and second allows you to convert those after-tax contributions over to the Roth version of the plan. So for anyone listening who thinks, wow, that sounds cool, like you have to ask your employer, is that even an option? All right. Being a good advisor is about balancing technical, hands-on, in the weedsy things with trying to simplify as much as possible, make it digestible and something that'll actually get implemented. So with that said, it's hard to strike that balance. How do you do that, making sure you're not foregoing complexity and detail that needs to be there, but not making things so overly cumbersome and complicated that it's like, what's the point?
Yeah, great question. So I'm typically going to go in the weeds when I'm actually doing a deep dive for someone for whatever strategy I'm recommending for clients. I'm probably not going to share 75% plus of the information that I've looked at making that recommendation. Now, I'm certainly willing to talk about it for the people that want to actually do the deep dive. I will be thoroughly prepared for whatever recommendation that I provide to clients, but I'm going to try to summarize and simplify it as much as possible. Again, going back to that customization to the client, like knowing what's this client's personality. Are they really a detail-oriented person where they need to understand everything, or do they just literally want to say, Mike or Andy, I recommend you do this, and they'll do it, right? And so it's really trying to customize that to each client. As I mentioned, earlier, keep most things in the planning software and really kind of do the planning in the actual software, other than maybe distributions or Roth conversion strategies. And then when I'm looking at things just like yesterday, when I'm looking at like after-tax yields on cash, I literally have a whole spreadsheet that I build and have every single client's information on it, current tax brackets, current tax rates, the state they're in, the percent, what the state exceptions or nuances might be, like, what is it, California, Connecticut, and New York.
Yeah.
You have to have like at least 50% of the bonds assets in U.S. obligation debt to actually get that deduction. And so I'm trying to think through all of that. So I have all that on a spreadsheet, and that allows me to quickly update, current yields, look at it across the board and see, all right, who needs to actually have a change here. So that kind of stuff is really helpful. I'm not ever sharing that with the client. I might just send them a quick email. Hey, hey, Greg and Sally, I'm just FYI, you'll see a trade in your account today swapping out, money market funds. That's just because we're trying to maximize after-tax yields based on, what they're currently yielding. So
Yeah. Okay.
Same thing for fixed income, and looking at, does it make sense for muni bonds versus, non-muni bonds and the corresponding deduction there.
It is interesting to see how different some clients are. At one extreme, some are just like, tell me what to do and let me know if I'm okay. I don't know anything else. And then others will want to see all your work, you provide it, and they want to see more, like to the nth degree of how exactly did you do this and how'd you optimize that, et cetera, and then everything in between. So it is could make for a wild ride sometimes. All right. Based on what you said before, it sounds like a lot of your clients, 5-ish million assets, if not more in a lot of cases. So I guess a lot of them have enough, but to your point, it's relative, right? If you're spending 200 grand a year, or 400 grand a year, it's a very different story. How do you help figure out and objectively figure out as objectively as possible whether or not clients have enough to retire or stay retired?
Yeah, it's a great question. And that, again, is very subjective with the person, right? Some people want every single thing covered, 100% likelihood of success on the Monte Carlo. They want to make sure that use conservative rates of return, whatever it is, moving forward. I do start with the Monte Carlo analysis within the financial planning software. I look at the withdrawal rates, from a pure, lots of people have heard of the 4% safe withdrawal rates. Well, that's great, but you kind of need to know if you're retiring at 62 and you're distributing 5% until Social Security kicks in, that goes down to 3. How does that kind of build in? So looking at withdrawal rates not only now but also from a longer term perspective. I look at clients' ability to adjust spending if needed. So let's say someone is in good shape, maybe not great shape for going into retirement, but let's say they're spending $50,000, or their plan is to spend $50,000 a year on travel, or they're gifting to their children or grandchildren each year. And we have a discussion with, hey, Mike, I'd like to do this, but if we have terrible stock market returns, I'm more than happy to pull back, do smaller trips, not, forego the gifting to kids or grandkids, whatever that is. So as long as we have a discussion about that, if you have flexibility in your plan, you can actually afford typically to retire earlier, right? Because if you have some kind of lever that you can pull, or different levers you can pull for funding your retirement, it gives you a lot of flexibility if we do have, a terrible stock market potentially, particularly in the first few years of retirement. We call that sequence of return risk, right? That's kind of your biggest risk, is those early years and the actual return on your investments in those early years. So anyone that has flexibility on that, I'm much more comfortable, unless if someone's right on the border and they absolutely cannot spend $1 less than what we're anticipating. Well, then I'm maybe saying, hey, working an extra year, if it's not that bad, might not be the worst thing for you, just to make sure you're going to be okay. But each person is different in their comfort level going into retirement. So again, just like all this, it depends, right? That's the perfect answer in financial planning. So
I had a thought when you said, working one more year could make a big difference. The impact of that is like twofold. Obviously, you're earning more money, right? You're also not spending money during that year. And not to be morbid, but you have one less year of projected life that you're going to have to cover your expenses after you stop working. So that's arguably the most powerful lever that hopefully is within your control. Now, if your employer boots you out, different story, but you can't control stock market returns. I mean, if you have a wildly good stock market one year, that can like blow your plan up in a great way, like really inflate your numbers and your outcomes, but you can't control that. To some extent, you can't control work, and that's a very powerful lever for most people to really bolster their plans. So even if it's just 1 year, it can make a big difference.
Yeah, or if you're completely burned out, could you go and consult? Let's say you make, just hypothetically, $200,000 per year, right? Just leading into retirement, and you could consult 5 hours a week and make $40,000 or $50,000 a year. Whatever that dollar amount is, and there's a lot of demand for it. Well, that might be a lot. If you're just burned out, I would strongly recommend you consider going part-time or consulting and having a better balance. And that can be a great way to transition to retirement anyway, right? And so that's taking less pressure off the portfolio. That could be another great way to still earn that income without having to go, 110% for another year or two or whatever that is.
Yeah, great point. It doesn't have to be all or none. Yeah,
exactly.
For those that do have enough but struggle, you touched on this before, changing the mindset from accumulating to decumulating or distributing, no longer saving, but taking money out. How do you help them sort of emotionally, as a therapist, get over that hurdle and start spending their money?
Yeah, so I am not a therapist.
Nor do you play one on podcasts.
No, I do not play one on podcasts. I think they provide a very valuable role, and it's actually super intriguing because, as I'm sure you found, I feel like being a financial planner is like part therapist, part marriage counselor, part financial advisor, everything else. You see a lot sitting on quote unquote this side of the table, right? But for people that are really having a hard time, spending what they've accumulated, I start with the overall analysis. Let's look at the Monte Carlo simulation. What are you truly afraid of? Is it inflation being higher? Let's throw it in there. Let's just see what higher inflation would potentially do to your plan, just so we at least have some understanding of what that kind of impact could be. Now, it's not going to be perfect, but we at least would have some kind of understanding. If all of that looks phenomenal and you're in really good shape, that's a much harder hurdle. I've actually heard of somebody getting a therapist to help them switching from accumulation to decumulation, which I actually thought was a great idea. I haven't had any clients do it, but I have actually spoken with someone that did. I'd love to follow up on them, actually, now that I think about it, to see how that went. But anyway, what I typically say is, given the financial goals and objectives that that we've worked on together, you no longer have a financial need to continue working. And then I just kind of pause and just kind of see. And I've had a couple of clients over the years literally just like relax and be like, wait a second, I hate my job, or maybe I like my job, but there are so many other things that I want to do with life rather than that. And so I'll say, is there something else you would rather be doing with your time other than working? Maybe work is the right thing for you, but maybe it's not. Maybe there's some other passion you want to do. Let's say if a client is retired and just not spending much at all, and let's say they have like a 1 or 2% withdrawal rates on their portfolio, or a 0%, they're literally not touching their investments. Is there something else you could spend money on or a gift that would bring you joy? Is that gifting now? I think you actually talked about it just recently in one of your interviews with a current retiree, the Die with Zero, which I'll talk about here in just a second, but I think it's fascinating. But is there something that would bring you joy today that that you really would make a difference in your life? Paying for a grandkid's college, or gifting now, making a large gift for somebody's wedding, that kind of stuff, where you can see someone's true excitement and making a difference in their lives when they're younger versus getting a larger inheritance later in life. The other thing that I've used a few times, not only for myself personally, but also for clients, is the George Kinder's three questions. So George Kinder is kind of known in the financial planning community as quote unquote, the father of life planning, right? He's been around for a number of years, taught a ton of different conferences and advisors, but he has three different questions that have really helped me, not only personally on some key decisions in my life, but also clients. And, one of those would be starting my own firm. It's interesting. What I think is actually fascinating about all this is you and I have actually somewhat gone through a life transition.
Definitely.
In that we left, it's similar to retirement, right? We left a good employer with great benefits and good pay to potentially make nothing for a longer, or even lose money for a long, some undetermined time period, not knowing if you're going to have any clients to serve. So it's getting over the emotional hurdles of that. It's getting over, I'm going to lose these connections in my life, these work connections that are really important to me. How do I replace those people? And how do I kind of recreate that? How do I structure my portfolio to be able to withstand those first few years? But going through those three questions, Andy, I'm sure you can link to those in your, in the show notes as well. I think those can be really helpful if you can really take some time, get away from everything, don't have any distractions, and just sit there and read one question at a time. Take some time to reflect on it, answer it. And I've even gone back to the questions that I answered years ago just to see if they've changed at all. It's been fascinating. And the last thing I'll mention is I've actually recommended a couple of clients read this, and it's the book Die With Zero. And I got the book first. It was recommended, soon after it came out to me. And I honestly could just not get through it. It just did not. It's very different than my beliefs and personality for many years. And then the author, I can't remember his name off the top of my head, but he was on a podcast with Peter Attia, who runs a big podcast called The Drive. And I listened to that podcast probably an hour and a half or 2 hours, and just hearing him actually communicate his message was just so inspiring to me and really changed my own thought process on trying to do stuff when it would be most meaningful in your life, right? So for travel, takeaway for me was traveling when my kids are young and want to be around us, and actually want to kind of create these memories and see how people outside of Richmond, Virginia live, right? It's everywhere is different. How someone might grow up in Spain might be very different. Madrid, Spain might be very different than they are here. And so just being able to have those opportunities to share with my kids is huge. Same thing with like philanthropic giving, and making a big difference today on people's lives versus potentially gifting a lot to charity, 20, 30, 50 plus years from now. So that's right. Those have been the ones I think have really helped me with some of these decisions, and hopefully have helped some of my clients kind of get over that edge. But I know it's hard. It's so emotional to make that switch if you've been frugal your entire life and just used to not spending much. So I get it.
And for us, for you and I agree. We've had our own sort of quasi-retirements, going from good paying, decently length careers in the corporate world with benefits and stuff, to starting with zero and having no income and not knowing how this, and having business expenses on top of it. Yeah. But our hope was this is going to work and we're going to get gainful employment from it. So very major life change for both of us. Different. And I'm not blaming you. I'm just saying out loud to people listening, like very different than working for 40 years and stopping completely and having no income. Like that's, I can see how that's, I can say I could put myself in their shoes, but I can't, like, to be frank, right? Because I haven't lived through that, knowing, okay, you don't get a do-over and you're stopping income completely from work, right? Yeah. Whereas you and I saw something. So I'm not sure I'm going with that, but yeah, it's I appreciate and try to walk delicately around it. I don't want to just tell people like, you're fine, get over it, go spend. Like, you got to have some tact and heart and empathy when trying to help people manage that, because it's hard. And I'm not a therapist. You're not a therapist. It's tough to do that. But all right, for folks that don't have enough, how do you help them modify? I think you touched on one of the levers potentially working longer, but outside of that, what else do you think you can do for folks that don't have enough and want to stop working? Yeah, so it's really four things. We already talked about working longer and or working part-time or some kind of transition period there. Absolutely reviewing expenses.
is there any kind of quote unquote fat in your budget you can potentially cut out there? I could care less where people spend their money. I mean, I truly could. It's everyone's different. Everyone's coming from a different set of values that they have. But maybe there's opportunities to, it could be something as simple as like your cell phone bill. And maybe you're paying $300 a month for cell phones that you could be paying, like 30 or 50, or, just something, kind of the small stuff on there that you could potentially cut back. Or, maybe you're spending $1,000 a month on eating out, and you don't value eating out. You do it just because you don't have the time to cook, and maybe you love cooking. Well, maybe that $1,000 goes to like $100, and all of a sudden that's $900 a month over a 30-year retirement period. That's huge if you can cut that out.
Yeah.
So kind of looking through stuff like that. And then the last thing, if somebody absolutely just retires against, even if it doesn't look great, retires anyway, like I'm done, I've done it, or hey, we've already retired. A unique thing that I don't hear many people talking about is actually trying not to make those inflation adjustments to the portfolio distributions. So, typically you're increasing those, every couple of years, you're maybe increasing portfolio distributions, maybe 3, 5, 6%, whatever it is, whatever inflation has been. But if you can just keep your spending level and not inflation adjust it, and then maybe just do it on Social Security benefits or whatever else you're receiving, that might be enough over time to keep you from getting in too much trouble. So those are really the 4 things that I at least try to look at least that are more common.
Yeah, agreed. And that's in effect cutting expenses. You're just doing it slowly over time, so you don't feel as much pain when you're doing it. But by not giving yourself the inflation increases in your distributions, right?
Yep, exactly.
All right, wrapping up here. If you can give only one piece of advice or word of wisdom to listeners, now this is consumers, not advisors you're speaking to here, about retirement planning, what would it be?
Yeah, life is short. Don't forget to enjoy the journey, to balance living for today while being mindful for tomorrow. I've been there. I've been thinking about retirement. I've looked at it and just get through here, just save X number of dollars, this year, whatever else. I'm going to be financially independent at this age. If that's all you're focused on, you're missing so many great life experiences that may really increase your overall well-being. And you might find that you actually work a lot more than you thought, right, if you have a really good work, balance outside of that. So I think it's the same thing with, we went through this with launching our firms. You're so focused on trying to get clients in the early stages. Well, it's been such a fun process coming up with processes and meeting new people and meeting other like-minded professionals. I mean, I'm truly having the time of my life, and I'm still not quite at full capacity. It's been awesome. So I would absolutely encourage people to try to shoot for that balance.
Yeah, don't do it with the reckless abandon, but don't put off things just thinking there's always, just save, and one day it's going to happen. I get what you're saying. Yep. Excellent. And finally, if people want to go learn more about you, your firm, et cetera, where best to find you and your stuff?
Best place is firm's website, so manukafinancial.com. That is MANUKA financial.com. I've gone back and forth with being more active in my writing. I hopefully will get more active to that here shortly. I do love to write and love to do blog posts and writing for publications and stuff. So that will hopefully be another creative outlet that I get back to here at some point. The blog is on the website. But the last thing I do want to say here, Andy, before we go, is I just wanted to say thank you publicly to you and to everyone listening. 2.5 years ago, I was about 6 months into running my firm and had a steady number of people reaching out and becoming clients. Everything was going well, and I met this guy named Andy Panko through our mutual friend Cody Garrett, who's also a phenomenal person. Just tons of great information out there if anyone's interested. And I remember being remember I was actually on a flight to New York. You were going to be you were out of town for a wedding or something. And I was on a flight to New York for my cousin's wedding in Brooklyn. And you very generously put in a plug for me in your Facebook group that I offered project-based planning at the time when you were no longer offering it. And I think maybe 700 people visited my website like that weekend.
Wow.
And probably 30 of them reached out by the time I was like back on Monday. And I've had a steady continued demand ever since then. It has been incredible watching your popularity rise over the last couple of years. You're so generous. I think you are truly making a difference in many people's lives, not only for advisors like me. I have a number of mutual friends I think that you are certainly benefiting, but also individuals looking to deepen their retirement planning knowledge. So thank you on behalf of everyone you have helped along your journey. We are greatly, greatly appreciative of you.
Well, why are you trying to make me cry? No.
Promise I'm not trying to. I just wanted to say thank you. I haven't had a chance to publicly thank you in the past. I know I have privately, but I just wanted to say how meaningful you have made a difference on my life, as well as so many others out there that I've personally witnessed.
Well, thank you. I'm happy to help, and I'm glad we crossed paths. And for those listening, I'm very anti-sales, and I try not to use my outlet, my content sources, such as the Facebook group, to promote neither myself nor others, but sparingly I do. And it's only when I come across something or someone that I truly feel you all watching, listening, reading can really benefit from this. And I believe this person's doing good and for right reasons. And so when I saw you, we chatted briefly. I'm like, this is someone I'd be fully comfortable sending my mother to. That's sort of my litmus test. And I wanted to get it out there. And for everyone listening, like, I've never received any sort of compensation kickback. There's no referral finder's fee arrangement with anyone I ever, I don't want to say promote, because that sounds like dirty in my mind, but long way of saying I'm happy to help you, to help others who benefit from having reached out to you, work with you, etc. I truly want to make this industry better for advisors and consumers alike. And if I can play a matchmaker using the outlet, it still blows my mind how the social outlets have worked out and grown. If I can use my reach and outlet for good and not just to monetize and make money off people, that pays me back like tenfold, more so than hitting you up for $1,000 because you got some client off me, anyway. So, but thank you, Mike. I was not expecting that. This was not plugged. Everyone listening, I did not tell Mike to say that, but thank you.
Andy did not know I was going to do that. So, yeah.
No, I did shed a tear a little bit, and it's not just from seasonal allergies. All right. Well, Mike, it was a pleasure. Thank you very much for coming on. I'm sure a lot of people will get a lot out of this, and thank you again.
And it was certainly a pleasure talking with you. I'm so excited to do this, and thank you for everything that you do. I appreciate it.
Awesome. All righty. Well, take care, everyone. Thank you.